Welcome to the first episode in Investing 101, a multi-part series I'm putting together with the help of my community to help you, the noob with a buck, become a total Chad investor. We're taking questions from our community in the Discord and making full-fledged videos out of them. Without further ado, let's get into part 1. Is all investing gambling? It's no question Wallstreetbets has brought in a ton of new investors, and that's fantastic. I've had people in my Discord say AMC was the first stock they've ever bought. Great. First off, welcome to the wonderful world of investing. The key to financial independence is financial literacy. Let's first take a look at the 3 types of investing that you can do in terms of time horizon. 1, day trading. These are super fast, high frequency trades. This takes advantage of the volatility in the market of a stock going up and down and is based on essentially no fundamentals whatsoever in terms of the company's value long term, because they don't care. They're going to get it and get rid of it within a course of milliseconds to hours to a day. The next category of time duration, these short-term growth stocks. Typically, these are based off of momentum plays or something else in the market that's going to play out in like the next month. Cannabis stocks or some renewable tech or EV company that's just about to go IPO. Let's keep an eye on them. These are these very infrequent opportunities, but could potentially have very high payoffs. I would classify AMC and GME into that bucket. And then you have your long-term retirement investing. This is a time horizon of years, not just 1 year, not just 2 years, but we're talking 10, 20, 30, 40, 50 years, right? Like you are literally saving for retirement. So here you have this time horizon from very short to incredibly long. This time horizon that you choose directly correlates to how much you're gambling and how much speculation you're using in terms of determining whether or not the stock is going to go up in price or not. So you're going from near casino to basically guaranteed profit. Now, counter to most people's insights, it's actually not the volatility that makes it risky or guaranteed. When you're taking these long-term positions, you're going from a negative sum game to a positive sum game. So let's break down exactly what that means and why. So first, let's look at high-frequency trading in a closed system scenario. There's always a buyer and a seller in these trades. And usually when we're talking about these high-frequency trading, we're talking about options, we're talking about derivatives, things where there's always a loser and there's always a winner, right? And those come in equal parts, meaning if I make money, you lose money. So that's a zero-sum game, but then you're not even considering on top of that commissions and SEC fees that are required to be taken out. Even if your bank says that they have zero commission for trades, there is still a mandated SEC fee, which the government takes out every single time you trade, just so they can maintain regulating the equities market. So when you factor that in, it immediately becomes apparent that high frequency trading and derivatives is a negative sum game for the traders. Now, does that mean that some people aren't more skilled and can make a profit in this game? Absolutely not. There's obviously high skilled poker players that beat the lower skilled poker players, even though the house is taking from every single hand played a little cut, right? So the house, no matter what, wins, but sometimes the better players will beat the odds. But to think that as a retail investor, you can actually win in this environment when these funds are using artificial intelligence to try to manipulate and measure and predict, I hate to tell you, but you're up against the machine here, quite literally. So as retail investors, this is not really a place you want to be, especially if you're new to the game. Now we understand why short-term, high-frequency trading is a negative-sum game. Let's talk a little bit about why growth stocks and long-term holding is a positive-sum game. Here we're looking at the United States market capitalization from 1980 to 2016, and this is sourced from CEIC data in collaboration with the World Bank. So this chart's telling us that in 1980, we in the United States had a market capitalization total, including our domestic companies, of $2 trillion. This is in 1980. Now, if we go all the way up to 2016, we're showing $33 trillion. Because remember, this is in millions. Now, to double check that data, just because we like to always get 2 sources, here we have another source. This is from Sibliz Research, total market capitalization of public US companies in millions. Here we're getting like a 32 again. It's actually showing in 2020, $50.8 trillion market cap. If you had invested $2 in 1980, it would now be worth $50. The market price of an asset does not necessarily mean that it can be sold for that price. Basically, let's say everybody who owns Tesla decided, hey, I'm going to start selling my Tesla shares, and they flooded the market with sell orders. That would obviously drive down the price significantly. And so as people started to sell, the price would drop, and not everyone would be able to exit their position at the current price that Tesla is valued at, $816. Meaning just because you have a stock that's worth $1,000 doesn't mean you'll be able to sell it for $1,000, especially if you're trying to sell during a period of high sell pressure. However, there is some base fundamental value like the factories, the steel, the engineering designs, etc., that have some innate value to them, right? And there's almost like a minimum threshold of price that people will be willing to pay to own that stuff. So although the previous metrics that I showed do incorporate some sort of speculation of growth in them, there is still this raw value that has been increasing over time. If I'm creating bread or if I'm creating some electronics device, that means I'm creating value that before didn't exist. And the fact that our ability to produce this value comes at an exponential rate over time because we're creating machines that now produce machines, which then create better things. And, efficiency just goes through the roof. And basically there is, so far, to our knowledge, no cap on this efficiency. And so there's a continuous exponential growth on our value production as a society, as a collective. So unless you believe that we'll stop creating this value, there's actually no reason to not be invested in the collective output of everything. And this is why long-term plays are the safe and steady bet that everyone should be involved in. And you should not let your money sit because then, in fact, you're actually losing money due to inflation. It's no coincidence then that we've seen a huge market cap increase given the fact that a bunch of money has just been influxed into the system from all the COVID relief packages that the government has issued. I would be skeptical of that being a permanent gain because the value that the companies have created has actually gone down due to COVID. So it's quite possible that we'll have a small market correction. But even when I showed you the graphs from 1980 to 2020, the 2007-2008 market crash is a blip, a tiny little blip on the system compared to the long-term growth aspect of the collective stock market. So, of course, I want to put my money in the positive sum game because it's more likely that I'll get money out of it given all the randomness that happens in the market. Okay, so we have talked about the different time horizons of investing. We've talked about inherent risks of those different types of investments, how some are negative sum, some are positive sum, which all brings us to the conclusion, no, not all investing is gambling. And in fact, it's wise to be investing your money because otherwise you're losing that purchasing power due to inflation. So if you have questions that you want answered in Investing 101, get your butt in the Discord, ask it. I'll be there to answer it. And then of course, we'll make some videos out of the really good, deep questions. Link to the Discord is below. If you like the video, subscribe, like, helps me out a lot. Lastly, if you've made it this far, we're also trying to put together a small project of programmers who are able to code some algorithms using APIs to detect certain opportunities in the market. If that's something that really interests you, again, hit up the Discord. We'll have a channel in there called Quant Trading, and we'll discuss project plans, how we're going to approach it, what broker we're using, etc. That would be sweet if you want to help. We need your help. Thanks for watching. This has been the Teddy Experience.